Hello and welcome. I'm Manisha Gupta and you're watching Commodity Champions. Well, the oil prices have cooled down as the hopes of successful ceasefire talks in West Asia erase some of those supply concerns. The prices of crude oil, gasoline and heating oil have declined by 5 to 6% in matter of a week. Another factor that is weighing on oil prices is the weak China economic data, which has fueled concerns over the demand from that country. Meanwhile, the metal prices have witnessed a rebound as fears of recession in the US have receded and traders are hopeful of US Fed rate cut this year. Well, the copper prices surged on the back of a strike at a Escondida copper mine in Chile. The 6-day strike has ended with BHP negotiating a deal. However, that could set the tone for upcoming negotiations elsewhere, with workers now emboldened by higher copper prices to push for a larger share of profits. To discuss this and much more, I am now joined by Ole Hansen, Head of Commodity Strategy at Saxo Bank. Ole, hi, let's start with metals first. And the months of June and July were not so great. We ended these months in negative for many of those metals. For the month of August, well, the last week, 10 days have been in the positive right now. How are you looking at, the demand from China, which continues to be quite uneven? Actually, all the data that you see in the last couple of days coming from China has been on the weaker side. Let's start with that.
Well, good afternoon, Manisha. Yes, absolutely. We went through this quite a steep correction in the past few months. The recession worries that grew in the US last month, which is now abated, also helped drive that process of weaker prices due to demand fears. But what we're seeing now, and basically after this deleveraging or momentum crash that we had at the start of the month, where a lot of speculative interest was reduced in the market, including commodities, we're seeing a small rebound here. And I think that's basically signaling potentially a low point in some of these industrial metals. We've seen a strong bounce both in copper and aluminium. And as you highlighted, this strike action in Chile probably helped support the rally last week. But with that now resolved, we're still seeing copper prices being underpinned. And that's also due to, I think, simply because the traders have been cutting their exposure to a level where this new momentum is attracting fresh demand. Also, we're seeing a small reduction in inventory levels in China of copper last week. And that's also helping to improve the sentiment slightly. So big question right now whether we have priced in most of this weakness that we've seen recently in China.
So at these current levels where we are off the lows, do you see these as buying opportunities into the market? And what would you want to watch out for? I mean, for this week, Jackson Hole meeting is going to be the most important thing. September would bring rate cuts from US Fed and various perhaps other global central banks as well. With the dollar index also trading at around 7-month lows, how much of support do you see all of that bring in case of metal prices?
Well, the weaker dollar is most certainly helpful. We've seen that as well in the last couple of days. Dollar, as you say, trading at the lowest point of this year. And Jackson Hole critical as well, because we do expect by now that Jay Powell will signal the beginning of the rate cut cycle starting next month. And that will bring down the cost of holding commodities, the funding cost in general, and potentially also add some support to the market. So Jackson Hole is critical. The investor interest, as you mentioned, I think it is a good level now to start looking at it once again. As I mentioned, if you look at high-grade copper in New York, the speculative net long has collapsed by 90% up until last week. And that basically means there's a lot of fresh room in the market if we see this momentum continue. So with that in mind, a signaling of a rate cut, and potentially, as I said, the worst being priced into China, then we could see a rebound from here.
So how much of a rebound are we anticipating, Ole? I mean, if I was to buy copper, aluminum, and even perhaps zinc, we've seen good gains come into that one as well. How much of an upside are you anticipating from here? So what is your risk and what is your reward?
The upside is not as great as the one we saw back earlier this year, where we had this AI craze, data center-driven demand for copper in anticipation of a spike in demand. we have to remember that commodities are spot traded products. You cannot buy a commodity in the assumption that demand will be very strong next year. It has to be strong right now. And that basically means that for now, it's mostly, I'd say, positioning being readjusted to accumulate some positioning. But the fundamental outlook is ultimately what drives the market higher towards, I believe, what will be a new record high next year. But in the short term, we need to see China stabilize even more. We need to see inventory start to come down. So I see a move higher, but nothing to the point that to the extent that we saw earlier this year. So this is more of a slow-moving train while we wait for the fundamentals to balance itself out and start to add some additional support.
But you wouldn't advise shorting metals at these levels?
Come again?
You wouldn't advise shorting metals, going short on metals at these levels?
No, I think we've seen most of the shorting or the selling in terms of the market responding to the negative news out of China, and also briefly the risk of recession in the U.S. having an impact. So I think with that in mind, we probably I think we've seen the low point at this stage.
All right, that point is well taken. Well, that's about metals clearly. But what is your sense on the crude oil prices? Because ceasefire talks and the Russia-Ukraine escalation, I mean, it's an everyday thing, really. And then the weakness in US dollar, the Chinese demand is another thing, really. All of these factors, do you see them putting further pressure in crude oil prices?
For now, probably not, but there are some concerns about this overhang of supply that OPEC would desperately like to put back into the market, whether the market can actually cope with that additional supply. So I think at this point, the short-term focus is really on whether OPEC abandon their plans to increase production from October. I think that's probably what we're going to end up with. While we see this, the demand outlook being a little bit challenged as it is right now, especially in China, where we probably will see peak oil this year. Sure, countries like India will continue to see increase, and that will take up some of the slack from there. But at this point in time, there's no room for OPEC increasing production, and that's weighing somewhat on the market. And as you mentioned, the geopolitical risk tends to come and go. Right now, we are potentially getting closer to a solution, and that has also been weighing on prices. But for now, there seems to be a floor in the Brent crude around the $75 level. But anyone looking at a chart is also looking at a price that's been going sideways now for more than a year and a half. And we will eventually see a break of that. And as things stand right now, the biggest risk is probably that we break to the downside.
And what's your sense with the U.S. elections coming in for the month of November? How much of an impact of that do you see on crude oil?
Probably not so much in the short to medium term, simply because producers do what they do best, and that is produce, and they have become much better in preserving cash in recent years. So we're not going to see if it was a Trump win, I don't think we're going to see a gun-ho blazing going into the market, seeing a strong rebound in production. It looks like production has been plateauing this year, and it is struggling. There is a struggle to increase production further from this level, and probably not the willingness either to do that. So I think producers are quite happy with current output levels, and the risk of increasing production further at this point in time obviously could weigh on prices to the downside, and that would be self-defeating. So I think the presidential election is probably more other commodities that could have a positive or negative impact of that.
Okay. Just one more word on crude oil prices. I mean, as you mentioned, Indian demand growth will continue to go up. And the latest data from the Indian regulator does show that India's dependence on imports is at an all-time high at around 88.7%, with 90 perhaps a level that most people are talking about now. How do you look at the Indian demand, the kind of dependence that we have, and what is the kind of number that you're working with?
I'm not working with the actual numbers when it comes to Indian demand, I'm sorry. But what we do see, obviously, is that just like there's a lot of focus right now on steel demand being struggling in China, we're probably going to see India pick up some of that activity, simply because you're still a growing nation. You're still a nation with a growing middle class, and that's really what drives commodity demand, urbanization as well. And that will continue to benefit growth and demand in India in the coming years. And right now, it's use a Scandinavian word, it's a smorgasbord of suppliers availability. So India can really pick and choose where they want to buy their crude oil from.
Oh, absolutely. One quick word on gold and silver prices also, because this is another area which has seen very strong gains in the last 1 week and overall 2024 as well. I mean, gold trading at yet another all-time high as we speak. What's your sense on this one? Where do you see the year ending, and would you advise buying gold at these all-time highs also?
Well, that is exactly the big challenge, Manisha, because simply, I think there's probably the biggest headwind for gold in the short term, simply the fact that if you're buying gold now, you're buying it at a record high. And that's probably preventing a few people or investors from getting involved and staying on the sideline for now, looking for correction. But we can see that the correction in the last 6 months has been very shallow. And that's basically indicating a market where buyers are waiting to buy this market on the dip. And that sentiment is still prevailing in the market. And now we got some momentum adding to the rally we've seen since Friday when we broke higher. The reasons for holding gold are multiple, and I think none of them are really going to go away anytime soon. And that basically means that gold's future looks bright for the foreseeable future. Where we're going to end, that's anyone's guess. We already reached my target for the year, which was 2,500. But I'm sure if we continued higher, then the market will start to talk about 3,000 sooner or later.
All right. And a quick word on silver as well, Ole, before we let you go. What are you expecting there?
Well, as per usual, where gold goes, silver tends to go as well, but faster. We saw that during the correction phase where silver lost quite a lot of altitude, also driven by the weakness in industrial metals. But if we have a combination of gold finding support here, holding on to its gains, the industrial metals sector stabilizing and moving higher, and the weaker dollar, then we are likely to see silver sooner or later reach back to the record highs, or not the record highs, but the highs we had back in March or April, May time. So I think with that in mind, silver, we also seen this week, the silver is actually outperforming gold once again as the market moves higher. So we still like silver.
All right. So what are the targets for this year end? 30, 32, higher than that?
Higher than that, based on the assumption that gold holds these levels and the ratio between gold and silver continues to come back down towards the levels we saw earlier this year. So potentially up towards the 34, 35 level.
All right. So very, very bullish on gold and silver, but buying opportunities coming in for metals as well. And the crude oil prices, of course, can continue to trade sideways. Of course, will depend on what all we see and hear in sense of events and data. Ole, as always, thank you so much for joining us and making sense of all that's happening in global commodities there. With that, we are heading into a short break. But coming up, the gold prices have hit all-time highs above 2,500 an ounce. We speak to Philip Newman of Metal Focus when we return.